Good afternoon. Welcome to the TheoTrade afternoon video. I'm Blake Young. Today is March 20th, 2025, and we're going to talk about failed breakouts, specifically in technology and healthcare. Now, this breakout in healthcare, or failure to break out in healthcare, is bearish, while the failure to break out bullish is in technology. So we're actually getting a setup for an opportunity to fade technology and buy healthcare at a discount. So we're looking to get into a position bearish in technology and bullish in healthcare at a better price on both sides. And part of that is what we're seeing going on in the economy and what we saw signals of and comments of in conjunction with the Fed meeting, the Fed rate decision, which all but signaled stagflation. So if we're talking about stagflation, we would expect to see retail sales slowing down and the growth there declining, Empire State Manufactured declining, and the fact that they didn't change the rates, that's fine. That's what we're expecting. If we have inflation without growth, we have to be very careful about cutting rates while we still have inflation, because that could crush the market as well. So as we're looking at this, it's interesting to see the Philly Fed do better than expected when the Empire State failed so miserably. But still, the concept is that we're seeing signs and clues and hints that we're in a stagflation situation. Existing home sales increased when we saw that dip in interest rates, and I'm not too worried about that level. But what I am worried about is if we have stagflation and the tariffs. Tariffs can certainly impact Germany, the Eurozone, the UK, Canada, Mexico, and the US, and all of that will be higher inflation. Again, higher tariffs does not mean growth. And so therefore, stagflation is still on the table. If that's the case, we should be looking at playing defensive sectors and going against overvalued or highly inflated positions or sectors. And even looking at the broad market, the S&P 500, you can see this very aggressive sell-off. 1, 2, 3. Today could be the fourth test of the highs on this major reversal on the S&P 500. And so the fact that we hit that low, this low, this low, this low, I would say we have 4 touches on the bottom and potentially 4 touches on the top, which would be a failed breakout in the S&P 500. And we know the S&P 500 is heavily weighted into technology. If we look at technology in the technology sector, you can see we've tried to rally off of these lows, but we haven't even filled this gap. In fact, we're testing that gap, the gap down, and the open of that candle as potentially a high. We've tried and failed, and today is potentially that same try and fail. If this is the case, this could be a massive bear flag. Now, I wouldn't play for the entire bear flag, but I'd probably go for the 227 down to the 207. I'd be looking for a 20-point move, which means an additional 10% lower if we can break through this low of 212. At this point, there's not a lot of risk to place a position early if you're going to place your stop back up here with the gaps and the highs through here. So I could take a position where I might risk $5 to now make $25 in technology. But I'm going to dig deeper into that and look at some individual stocks. And if we just roll through some of these stocks in the technology sector, like CRM, you will see Salesforce has done a similar situation where we had a gap. We've tried to fill that gap, and it did fill the gap, but then it failed and gapped down again. So this gap here on the 12th, we've failed. So if this could be a bear flag, this one gives us a 330 down to a 270. A 60-point potential move would bring this from 276 all the way down to 216. Now, to be able to see any lows that are associated with that, we'd have to go all the way back and look at, in essence, a retest of the annual low on CRM or Salesforce. And keeping with that theme, you're going to see many of these tech sector stocks are doing the same thing over and over and over again. Lower highs, lower lows, gap down, trying to break free over the last week, and it can't do it. It's failure. And you can see even here, the volume on Oracle is getting lighter and lighter as we're trying to recover. If we're in a stagflation situation, the investments are not going to be going into growth type stocks. It's going to be going into defensive plays. And so as we're pushing up into this area, a failure here and a failure to break out, I don't have to wait to break through the flag, but you can see a pretty consistent slope off of that, which is what I would normally use for the flag portion, and say if it breaks below this low or this trend line, then we could see a 180 down to a 140, a 40-point move on a $150 stock. That's a 22 to 25% potential move in Oracle on the next leg down. And if we're talking about a 22 to 25, we're talking about $40, and that's going to bring us down to 110. And if we look at Oracle, 110 is similarly retesting the annual lows, erasing the rest of this year and going back to a trailing 12-month low on Oracle. They match. They look the same. Oracle looks the same as what we just saw on Salesforce. Microsoft is doing the same thing, but the problem with Microsoft is it just put in a yearly low. And as we're looking at this bounce, if we clear this low, I would be looking for 420 down to 370, so about a $45 to $50 move, and a $45 to $50 move would give you about a 15% break below these lower support levels. And again, you'll notice it's a pretty consistent upward sloping lows to give you that confirmation of a bear flag in Microsoft. And the last one we'll look at in technology would be AMAT. And AMAT has created a similar bear flag type pattern, consolidated through here. I would argue this one broke today. So we've struggled to break through 156 over and over and over and over again. And we gapped down through those lows. So the fact that we've recovered through here, the risk associated with this may be $3. But if this can be the bear flag, we're talking about a move from 178 down to 145. Maybe $30, $35. So potentially a $3 to $4 risk for a $30 to $40 move. And AMAT, similar to Microsoft, has already put in an annual low, so a break below here would take us through into a new 52-week low. And I don't mind buying breakouts of 52-week highs or breakdowns below 52-week lows, shorting those to benefit from the dominant trend. And those look very, very promising as far as the chart's concerned. Now, when you look at healthcare, healthcare doesn't look the same as a failed breakout and a bull flag like we saw in technology, XLK. But as we're looking at this consolidation after widening pattern, it does tell me healthcare is kind of anyone's game at this point. Higher highs, lower lows, center. But if we look at the individual stocks inside of here, you're going to see that similar inverse or mirror image of what we just saw in technology, where we've rallied, we pulled back aggressively and set up for potential bull flags or next leg up. Starting with Johnson & Johnson, you can see that we hit our head, pulled back exactly to the same support. And this isn't just the short-term support. This goes back over a year. So 162 is an area that has been defended, protected, gap down, closed up. So there's your exhaustion gap. You're protected 1, 2, 3, 4, 5, 6 times just in the last month and from a longer time period. Now, this is not as clean of a bull flag kind of pattern that I would look for, but if we can break through this high, I would expect it to minimally give a $6 move, but this could be a bull flag type of move, even though it's not a bull flag pattern. And we could be looking for about $14 move above the high. A $14 move above 168 will take you to a new 52-week high, and $14 move is going to bring you up to approximately 182. And from here, what risk do we have to take? If we can go from 162 to 182, we're looking for a $20 gain, about 15%, and the risk that we'd have to take would just be $2 or $3 to see if it's going to continue to defend this low. AstraZeneca has had a phenomenal recovery off of its lows, going from 62 all the way up to 78, pulling back, creating some consolidation. This would be a symmetrical triangle, potentially. And if we can break through the highs, not only do we expect it to move this distance from 74 to 78, which is about 5%, but again, we could repeat what would have been the flag pattern from here. So 68, 78, we're looking for a $10 move above 78. That would take us to 88. And again, because this is more of a symmetrical triangle, we could get away with maybe a $2 stop for a $10 move. So we could get a 5-to-1 reward risk ratio. And if we go to 88, just so you can see where 88 lies, that's a retest of the 52-week high. So it could be a new 52-week breakout and a continuation if it can get out of this consolidation. Right now, I'd be more conservative on AstraZeneca, waiting for it to break free. Now, you know I've talked about CVS recently. I like CVS. And CVS has done a lot to break free and it's just kind of melting higher at this point. But I was waiting for this. We talked about buying the bounce, buying the bounce, buying the bounce. And 2 days ago, we closed above the highs of all this price action. Closed above, not just traded above, closed above. So we cleared all this out. Closed above, closed above, closed above. We put a shadow all the way through this high. I still like CVS. I've talked about this multiple times over the last couple of weeks. I like CVS, and CVS's earnings and pullback and consolidation through here. There are two targets I'd be looking for. Number one is a $5 target above that 67, so I'm looking for 72. But even though there's a gap in here, I would treat that gap as a great big green candle. So going from 55 to 77, we're talking about a $12 move, and I'd be looking for this to go to 89. If we look at CVS compared to 89, we have to go all the way back past the yearly high and go into a multi-year perspective. If we go back to 3 years, you'll see that's where we have a lot of consolidation, about 89 going back to 2023. The previous support, the previous resistance, some consolidation that I've been looking at, and so 89 could be on the table. It might take 6 months to get there, but if we're looking at that move, we're talking about 25% move in 6 months. CVS looks very promising to continue to recover and move higher. Now that's what I'm looking at as far as technical breakouts and patterns and setups in healthcare and technology. Certainly take the time to determine whether it's better to take the stock position long, the stock position short, whether it's better to do a long call, a vertical, a short put, or whatever strategy you're most comfortable with for the risk to reward and these opportunities. Some of these could take months to play out and therefore would need a longer term strategy or longer term options. But that's going to do it for me today. Thanks for watching. Join me again next week as we continue to discuss what sectors are setting up and some real opportunities in these markets.